Good morning. Penultimate trading day of October, final day of the week, so definitely interesting scenario playing out here. And let me just switch up my chart, sorry, because we absolutely have to start the briefing by talking about bond markets. So this has definitely been a kind of interesting, like, stealth move for yields that actually aren't stealth anymore. It's now it's extended far enough that it now becomes, front page news of the financial press. I've got two bond markets here that I'm showing you on the charts. The left hand bond market is the Bund and the right hand is T-note, so both 10-year durations. And you can see that. Well, I think let's talk T-notes first, given that downtrend is more pronounced. If you go back to the Brexit spike, so end of June, price is driving higher. This is yields getting driven lower on safe haven flow, of course, from the fallout from the Brexit vote. And really then things consolidated. But really since the middle of July and definitely coming into mid-August and then September and certainly now October, there's been this consistent trend to the downside. And here we are with T-note price points now down, looking at testing the 129 handle. And in fact, the low point we've had this week, 129.0750, is just about below the May low. So we're actually back to the lowest price point since April. This puts yields on the 10-year, well up above 1.8%. In terms of targets further down, then certainly you look at that March low on the continuation, down at 128.16 and a half. Look at the Bund. The Bund's made a key break this week, and it's taken out that low we had on the 12th of September, or the week of the 12th of September. So for Bunds, we're actually below that April low, and so this is the lowest we've been for Bunds since March on price, and therefore it's the highest we've seen Bunds on yield. One thing to note with regards to German debt, which is pretty notable, is that actually the 5-year bond yield in Germany has gone back up above minus 0.4%. So actually now the ECB are able to buy German 5-year bonds. Now they haven't been able to do that as part of their QE program for many months. So does this, one thing I'm only going to touch on now, I won't go into it in any detail at this point, but one thing to think therefore is, well, hang on, if we've got a risk that the ECB aren't going to be able to implement their QE extension, well, isn't this a good thing then? Yields rising, meaning that there's more available assets for the ECB to buy. And that is true, except that the key barrier, the key implementation risk, is actually not the yield floor. It's actually the capital key, which is it's the capital key in combination with then the limit on how much they can buy from any one issuer. So it's the fact that the ECB can't own more than 33% of German bonds, and it's the fact that the capital key means they've got to spend 29% of the monthly printing. So it's about 22 billion of the 85 being printed has to be spent on German debt, and it's those two factors that are the kind of barriers to extending that program. So even though yields are climbing, from an ECB implementation point of view, it doesn't actually help that much. But why are yields rising? Why are prices dropping? And I'm going to switch my screenshot. We're going to start and we're going to talk about the UK. There's several reasons why yields, and this is a global thing, so US, Europe, Asia, yields are on the rise. Now there's several reasons. One of them's the UK, which seems to be a bit of a trigger point here. This is the inflation chart for the UK, and as we know over the last few weeks, we've seen inflation tick higher, and then we had this big jump up to 1%. On inflation for September. As you can see on this chart, easily the highest we've had in this 12-month picture I'm showing you. Marmite Gate was a national front page story. This is where we're really now, as a whole nation, aware of the fact that prices are going to go up. And that's important. When the whole nation is conscious of that, then it has a notable impact on consumption. So, I think this alone, I think Marmite could well be responsible for seeing or bringing to an end this kind of weird honeymoon period we've had for UK economic conditions post-Brexit vote. This cheap sterling stimulus we've seemed to have received, I think's done. And I think we are going to see economic conditions in the UK now take a turn for the worse. So this inflation print here has led to UK gilt yields rising sharply. Here's a chart of UK gilt yields. You can see what happened here after the Brexit vote. Yields plummeted and we went down to a record ever, all-time ever low, 0.5%. But look what's happened ever since. And here we are back up, well above 1.1. We're actually trading up around 1.2% now, back to levels not seen since the Brexit vote. So I think we've seen a turn on UK yields as a result of inflationary pressures coming through quite notably in this country. Okay. Now, what's this got to do with the rest of the world, though? Why are other yields also climbing? Well, I think this is now translated, and let me transition my chart back to transition the screenshot back to my charts. Think about inflation globally now. Obviously, in the UK, we've got this unique little situation because our currency has collapsed in value. And so we're going to see a sharp jump in inflation. But what about everybody else? Because nobody else's currencies has collapsed in value. But the other big factor that's been driving inflation, of course, and one major responsible factor for inflation being at record lows over the last couple of years is this thing here. It's oil. So what's happening with oil? We'll check out where we're trading right now. And the important thing here is actually not only are we trading at $50, which is the highest basically we've traded since the middle of 2015. Not only that, but actually for the whole of October, we've been in a tight little range around $50. It does look for now like oil prices have stabilized. We've only had like a plus or minus 2% range for oil, or plus or minus $2 range, I should say, for crude oil around the $50 area for the whole month. So $50 for the price of oil in the month of, let's say, October 2016. Well, what was the price of oil in October 2015? Well, you go back and you see that it was, down at $45. But check what's coming. From an inflation point of view, oil collapsed at the end of 2015. November's price point was more like $40. December's price point was more like $35. Look at January, it's down at $30. The point I'm making is if oil stays at 50, which is almost certainly going to do, and that's because OPEC have now changed their strategy. They've won back market share, not from the shale producers like they originally intended. They've won back market share from Asia, Asian increase in demand. So they're happy now, and they're absolutely looking to defend price and make sure it doesn't drop away and below 50. So OPEC have changed their strategy. This means in the next 3 months we're going to have oil at $50. And when you look at that on an annual 12-month comparison, you're going to get, especially when we hit the start of 2017, we're going to have oil at $50, and on a year-on-year comparison, it's going to compare to $30. So you're going to get actually quite sharp upside inflationary pressures from the price of oil just staying at $50. So this is one thing. Oil is leading to upside forecasts for future inflation, which is helping to drive up long duration yields, right? So that's one thing. So you've got Brexit, inflation coming. You've then got oil price inflation coming. And then thirdly, and perhaps a little bit more subtly or broadly, we've been talking about a topic for many months here at the Amplify office, and that topic is about the fact that ultimately, permanent quantitative easing and negative interest rates is not the way. It's not the way forward. It's not how policy setters are going to get this global system back to normal. The negative side effects that we've talking about at length, particularly with regards to the flattening yield curve and how negative that is for the banking system. Never mind anything else like pension gaps and insurance companies and all the rest of it, pensioners that as well, not hitting retirement with just no money to survive on. So there's obviously big issues here. Now I think slowly we're beginning to see a realization and a dawning of a realization into this. Now we've had rumors on ECB tapering, of course. Japan have changed their strategy. They're looking more at a yield curve strategy rather than just stubborn and permanent, more of the same. And the Fed are going to hike. We've now got a 75% chance that the Fed are going to hike in December. So I think you have had, it's almost been undercover, a slow motion shift. It's almost like the quantitative easing juggernaut has been trying to slow down and stop, then do a U-turn and then come back. But the juggernaut's been so massive that it's taken months and months and months for this thing to even stop, never mind begin to turn around. So I think this is slowly happening, and this is positive for yields as well. If QE really is over, and look, it's not over, I don't mean over as in they're going to stop it now, but if the strategy and the policy of just let's do more of the same is beginning to look like not the best way forward, then I think we've got to revise our future QE expectations, and that's positive for yields. We're going to need more fiscal stimulus, I would say, in 2017, not monetary stimulus. So I think this is all part of this story that's driven yields. And the 10-year on the US, the chart on the right-hand side here is a really good example of this. It's been happening for months, but now we've broken lower and we're trading at 6-month lows on price. It's starting to grab people's attention. Now, what's happening here with the equity space? Let me just flick to some equity charts, and let's look at the DAX, and let's look at the S&P, and talk about some other stuff that's influencing markets this morning. So you've got the S&P that's broken below that low point that we had yesterday. So into the close last night, we slipped lower. We broke below the low point on the 26th of October, so 21.22. And look what's happened this morning. We've had a pretty sharp breakout as well. And so far the low of the day is down at 21.16. I will just make an official reminder of the bet that I have with the guy you can see there, a guy called Vass. We made a bet at the start of October, and I bet that the S&P would be trading below 21.10 on the 31st of October. Now my bet was not looking good, literally just, well, even 24 hours ago was not looking good, but it's, as Vass knows, it's all about the timing. And the 31st of October is coming, and just in time. We've got some downside here for the S&P. What's helping with this, other than yields rising, it's actually, let's take a look at the earnings situation, because we've had a lot of earnings last night, a lot of earnings reported this morning, and whilst you got some good stuff in there, Google had some decent numbers. Obviously they're always going to be an important earnings report given the size of that company, but talking about big large tech firms, it's actually Amazon that's kind of grabbed the headlines a little bit. Amazon's share price has dumped 9%. Let me show you. Here's a chart of the Amazon share price, plummeting down to $770. That compares to the 820 we were trading yesterday. So Amazon sharply lower off the back of their earnings overnight. On the face of it, their earnings were okay when you look at their sort of revenue, but they missed on their earnings. 55 cents per share. Estimates were for something in the 70s. I think it was 78 cents a share. Anyway, they missed quite a bit on the earnings side, on the profit side, and this is because it looks like they've relaunched their kind of spending spree. Amazon, really forever have always been a company that's invested everything back into growing the business. They've never really made any profit. That's because they reinvest it all the time. We did get a bit of profit coming through finally first half of 2016, but that little bit of profit, Bezos has basically said, right, let's just start spending it again. So they spent a hell of a lot on new distribution centres, ever closer to city centres. They've also spent a bit of money on also opening up some bricks and mortar retail outlets on the west coast of the US, which is where you can go and collect items you've ordered online. They've also spent a hell of a lot on their Amazon video, so they spent a lot on directors and actors fees producing original content, and so on, right? And so despite the fact they've seen really strong revenue growth, it's only hit expectations, and it's disappointed on the profit side. Now here's the best thing out of all of, well, what I thought was just incredible. So Amazon's guidance about quarter four, going into Christmas, you know, their best quarter, of course, their forecast on how much net income they're going to make in quarter four, this is Amazon's own forecast. They've got a forecast and their range, they've given it a range, and they think they're going to have a net income of between 0 and $1.3 billion. Now, I'm sorry, but what's the point in having that forecast? How can it possibly be the case that a company doesn't know, you know, to within more than $1 billion of what their net income is going to be over the next 3 months? I just find that incredible, and I think causes a lot of concerns. This is a lot to do with the share price decline overnight. It's guidance about quarter four, and it's the idea they actually genuinely think they might not make any net income. So share price for Amazon down sharply. Now this morning in Europe, we've had a whole bunch of big guns reporting. We've had some decent stuff. RBS shares up over, up about 5%. But the big one for Germany, and let me switch back, look at the chart, something that's been driving the DAX lower, that breakout we had earlier, AB InBev, bad earnings, down 5.5% this morning. That's the kind of headline grabber from the European earnings set, with Amazon being that the equivalent from the US. And so it's just set a negative tone, and the bond yield movement is just cause for concern. And you know, this is what's kind of driving price action. Let's have a look at the earnings calendar, because we've got quite an interesting set of earnings. One other thing just on the inflation side, sorry, I should have mentioned this when I was talking about inflation. The other thing was we've had German regional inflation numbers this morning coming in from Saxony at 8 a.m. that actually saw an increase year on year from 0.7% to 0.9%. Month on month from 0.1 up to plus 0.3. So that's also played into this theme that we're starting to get upside expectations on inflation. Let's look at the the economic data calendar I've got on the screen now. So we're going to get a whole bunch of regional inflation numbers from Germany continuing at 9 a.m. So we want confirmation here. Have a look at your headline feed at 8 a.m. You'll see those Saxony numbers. Have a look, 9 a.m. we've got Bavaria, Brandenburg, North Rhine-Westphalia. Okay, that last one's at 9:30. So Germany do it a bit differently to everyone else, in that they report inflation regionally, and then you'll see at 1 o'clock today on the calendar, we've got Germany as a whole reporting their CPI. This is preliminary numbers for October, so it's the most up-to-date inflation data we have. But that 1 o'clock number is really redundant, because we get all the sub-regional components reporting before then. So you can pretty much, even though that the national CPI number is in bold here on this economic data calendar, it's really the regional numbers that are going to move markets if they're out of line with previous's. We don't get expectations for the regionals though, but we want to see at 9 o'clock, are we going to see a 0.2% jump in inflation in October compared to September? And if this continues the 3, or is it going to be more, plus 0.3%? And if so, you're going to see more pressure coming in on bond markets. And I'm just looking, the euros had a decent sort of, if you're thinking about inflation, well then if it's bad news for bonds and bad news you would say for equities, well it's good news for the euro's value. And we've seen the euro's value ticking higher this morning, perhaps as a result of those Saxony inflation numbers. So important regionals coming out of Germany at 9. More stuff out of Europe at 10, not massively important. The business and consumer and so on confidence numbers, they're not really market movers. But the big data of the day is absolutely undoubtedly the US Q3 GDP print. Of course, part of that, part of the situation in the UK was better than expected GDP figures yesterday, of course, coming in at plus 0.7 for the quarter, albeit absolutely entirely as a result of the services sector. You take all the other sectors, they contracted. So we do have we're really a bit of a one-trick pony at the moment with regards to what's driving UK growth. But look, we've got the US equivalent. Now, we're expecting 2.5%, as you can see here. Let me just show you the chart of US GDP. Here it is. So we're expecting 2.5%. Now you can see on this chart that if it's in line with expectation, it pretty much matches Q2 from 2015 and pretty much puts this GDP print right up at the top end of the range that we've seen for the last 2 years. Okay, 2.5%. That's on an annualized basis. Now do bear in mind the US economy has grown above 3% on average for the last 40 years. So even though 2.5% on this chart looks good, top end of the range, it's actually still below average. Check out 2013 and 14, which sure was more volatile. You saw that contraction in Q1 of 2014, but we had some punchy 4 and even 5% prints in the summer of 2014. That was we're a long way off those days. Q2 1.4. There's nervousness that this number's going to undershoot. The bottom end of the range, I think, is down at 1.3 or 1.6%. I mean, if it's below 2%, that's certainly bad news. You could say, is this going to then lead to the Fed rate hike expectations declining? Well, yes, but I think this GDP data is going to have to be very bad. I would say below 1% for it to really have any major impact on Fed expectations. That would be my feel. I think the Fed just want to get on with it. I think GDP growth is low and the Fed want to hike anyway. So the GDP growth staying low, I don't think will change that. If we get a positive upside surprise, is it possible that the November meeting is on the table? Are we going to get a hike next week? If you get, I don't know, let's say you get a GDP print here that's whatever, 4%, let's say, are the Fed going to hike next week? And I would say no. And that's simply because of the election risk, even though it looks like Clinton is a shoo-in. And let's just have a look at an infographic on this, even though, actually, sorry, I did have it. I did have an infographic. Now I've lost it. Apologies. I'll find it. Here we go. Sorry about that. So even though it looks like Clinton is going to win the election, even without having to win any swing states, which is quite amazing, even though it looks like Clinton at a landslide, pollsters are not very good at their job. We've seen that this has been proved. The Brexit vote categorically proved that. Don't underestimate the protest vote and the inability for pollsters to actually capture that. But as it stands, Clinton's a shoo-in, right? But I think the Fed aren't going to be prepared to hike rates just 5 days before the election. So I don't think actually this GDP print today is going to have much of an impact on Fed expectations. Maybe it might do in the short term, like this afternoon, but I think as we go into November, we'll start thinking and still expect the Fed to make a move in December. Okay, All right, data-wise, let's just finish off on that data calendar because there is more stuff after the GDP print. We've got University of Michigan at 3, but this is the final reading. We had the preliminary one last week. We're expecting 88.1, very small uptick from that preliminary print we had last week. So it's really all about US GDP this afternoon. This morning, it's all about keeping an eye on that German regional inflation data that's going to be announced. Well, now actually, sorry, I've been talking over that. But it's more about that theme with regards to bonds.
CPI month on month 0.2 in line with previous and year on year.
Right, so actually,
also in line with previous.
Bavaria's coming in and reporting that inflation has not gone up. So in Saxony we had a plus 0.2% uptick, but in Bavaria it stayed the same. So that's something to note. That's obviously a reverse of that figure we had earlier. So we'll see if that has an effect. The euro's ticking a little bit lower off the back of that Bavaria print here. But look, in the main, I think more broadly, we're going into the end of the week. It's we've got bad news on earnings. We've got bond yields globally on the rise, and this is cause for concern. And then it's just all about the US GDP print, 130. Okay. All right, guys, that's it from me. Enjoy your sessions. Thanks a lot.